We shall continue with the capital budgeting session, wherein we're still discussing on the discounting method technique, and we're doing the net present value method. Okay, so let's look at another question. Alpha Company Limited is considering the purchase of a new machine. Two alternative machines, A and B, have been suggested, each having an initial cost of rupees 4 lakhs and requiring rupees 20,000 as additional working capital at the end of the first year. Earnings after taxation are expected to be as follows. We have cash inflows. We have 5 years given, and each of these 5 years we have machine A and machine B. Okay, inflows against machine A and machine B. Right, so let's look at machine A first. In case of machine A, first year 10,000, second year 1,20,000, third year 1,60,000, fourth year 2,40,000, and in the fifth year 1,60,000. And then for machine B, first year 1,20,000, second year 1,60,000, third year 2 lakhs, fourth year 1,20,000, and in the fifth year 80,000. Additionally, they've given the company has target of return on capital of 10%, and on this basis you are required to compare the profitability of the machines and state which alternative you consider financially preferable. Okay, so if we look at the question, we have to calculate, whenever we calculate net present value, remember we always take into consideration, we have to take the present value of cash flows, and from this value we have to deduct the cash outflow or original investment minus cash outflow or your initial outlay, or also known as investment, right? Okay, so present value of cash flow, we know that we have to do those calculations. Remember, we make the table wherein we take the year, we take the cash inflow, and then we multiply it with the discounting factor in order to get the present value, and then sum total to get the total present value of cash flows. Okay, so this step we are going to need also a discounting factor, and in this question we have here they've given us return on capital of 10%. So if return on capital of 10 is 10%, which means this is our discounting factor or the PV factor. So present value we calculate at the rate of 10% per annum. Okay, and then minus cash outflow or initial outlay or investment. In this question, we have initial cost of rupees 4 lakhs and requiring 20% as additional working capital at the end of first year. So initial cost is going to be equal to rupees 4 lakhs plus at the end of the first year rupees 20,000. So there are going to be two inflows. This is at year 0 and this is at year 1. Okay, I hope you remember the concept of year 0 and moving forward the other years as well. Okay, so let us start first with the calculation of the cash inflows, the present value of the different cash inflows for your projects. So I have already prepared my table right here, statement showing the profitability of the two machines. We have cash flows after tax, we have year, cash flows after tax, present value factor, and present value of cash flows after tax. Under cash flows after tax, I have subdivided into machine A and machine B. Similarly, under present value of cash flows after tax, I've subdivided into machine A and machine B. And I filled up all of the amounts and all of the details that I have received from the question. Okay, from the question, I have year, cash inflows for A and B, so I filled those up already. Okay, year, and adjacent to those, machine A, machine B, the cash inflows in each year. Now, the next step for us is to calculate present value factor at the rate of 10%. Now remember the formula. Present value is equal to 1 divided by 1 plus I to the power n. Okay, which means that in the first year it will be 1 divided by 1 plus I is your interest rate, so 0.1 to the power of 1. Okay, I hope you remember how we do this. And after that, for the second year, it becomes 1 divided by 1 plus 0.1 to the power of 2, 1 divided by 1 plus 0.1 to the power of 3 for third year, 1 divided by 1 plus 0.1 for the fourth year, and for the fifth year, 1 divided by 1 plus 0.1 for the fifth year. And then we have to calculate these figures in order to get the actual present value in each year. Okay, So I've calculated and I've written down these factors here. For the first year, it is 0.909, second year 0.826, third year 0.751, fourth year 0.683, and for the fifth year 0.620. So the next step is to calculate present value of cash flows after tax. So if you remember, again, let's number our columns: first, second, third, fourth, fifth, and sixth column. So in order to get the answer for the fifth column, which is present value of cash flows after tax for machine A, we have to take cash flows after tax for machine A, multiply it with the present value factor at the rate of 10% for the first year, second year, third year, fourth year, and fifth year respectively. Okay, so the column number 5 is going to be equal to column number 2 multiplied with column number 4. Similarly, in case of number 6, it is for machine B. So cash flows after tax for machine B multiplied with the present value factor. So it should be column number 3 multiplied with column number 4. Okay, so let's proceed with these calculations. First here, it's going to be for machine A, it's 40,000 into 0.909. So that should amount to rupees 36,360. Okay, so let's calculate for machine B as well. For the first year, 1,20,000 into 0.909 should give us rupees 1,09,080. Okay, so similarly, please calculate for the remaining years as well for machine A and machine B respectively. So I've gone ahead and calculated the present value factors for machine A. For the second year, it is 99,120, and for the third year, it is 1,20,160. For the fourth year, it is rupees 1,63,920, and for the fifth year, 99,200. Whereas for machine B, for the second year, 1,32,160, third year, 1,50,200, fourth year, it is 81,960, and for the fifth year, 49,600. Okay, so now we have the present value factors for each year. Next step for us to do is to calculate the total present value factors for each machine in the total lifetime. Okay, so for machine A, it'll be 36,360 plus 99,120 plus 1,20,160 plus 1,63,920 plus 99,200. And similarly for machine B also, all these factors, sum them up together and calculate the total present value for each machine. Okay, so the total for machine A, total present value is 5,18,760, whereas for machine B, it amounts to rupees 5,23,000 exactly. Okay, so now that we have the total present value, from this we are supposed to deduct the initial investment or the original outlay. Okay, so from the total present value, the next step for us to do is less investment or the initial cost. So initial cost. Okay, so as we've mentioned already, initial cost is rupees 4 lakhs and requiring additional rupees 20,000 as working capital in the first year. Okay, which means that in this rupees 4 lakhs, right, that we're getting, rupees 4 lakhs is in year 0 as we've mentioned already. Okay, because rupees 4 lakhs is what is invested before you start the project. So before you start the project is always going to be equal to year 0 or year of investment. Okay, so if it's year 0 or year of investment, it means it is the present year. So this value, rupees 4 lakh, is already the present value. Already present value of cash outflow. Okay, it's already the present value because it's the value that is invested today, year 0. We are in year 0, and these values, right, these amounts are potentials that we are going to be getting in the future years. Okay, so that's why we had to calculate all these present values. Okay, I hope you understand that entire concept. And then you had also requiring rupees 20,000 as an additional working capital at the end of first year. And then you have rupees 20,000, which is at the end of first year, so it will be year 1, which means that it is something that is invested in the next year. Okay, we are assuming that this value is going to be invested in the first year, but we don't know exactly how much it's costing us had we invested this 20,000 right now. Okay, so we have to calculate the present value of cash outflow for the first year of for this rupees 20,000. Okay, for rupees 4 lakhs, we don't have to calculate anymore because this is the original investment or the amount that is invested at the beginning of the project, which is year 0. Whereas for rupees 20,000, because it's invested at the end of year 1, so we have to calculate the present value of cash outflow. So under this situation, N is equal to 1 and I will be remaining the same, which is 10%. Okay, so let's do this now. Let's carry it forward in the solution. So less initial cost, which is, there are 2 years, right? So I'll write year 0, which is rupees 4 lakhs, which is the original investment. Rupees 4 lakhs for both of my projects. And also we have at the end of year 1. Now at the end of year 1, it is going to be amounting to rupees 20,000 into 1 divided by 1 plus 0.1 to the power of 1. Okay, as I've mentioned already, N is equal to year 1 and I is equal to 10%. So 20,000 into 0.909, basically. That's all it means, because present value in first year is 0.909, right? So this also is going to be equal to ultimately rupees 20,000 into 0.909. So for both years, we can calculate now and see what is the present value of cash outflow at the end of year 1. Right, so 20,000 into 0.909 amounts to rupees 18,180. Okay, so for both cases, because the investment is the same, so it should be rupees 18,180 for both machine A and machine B. So now the next step for us to do is to finally deduct these amounts, 4 lakhs and 18,180. Okay, we have to deduct these amounts from the total present value, and whatever balance we're getting is the net present value. Okay, so let me just close these rows here. Close the column, these 2 columns there, and finally total present value minus initial cost is equal to net present value. So net present value is equal to, for machine A, 5,18,760 minus 4 lakhs minus 18,180, so it is rupees 1,580. And on the other hand, for machine B, it is 5,23,000 minus 4 lakhs minus 18,180 amounts to rupees 1,04,820. Okay, so we have calculated the net present value for each of the machines. Now, in the question, they've also told us, compare the profitability of the machines and state which alternative you would consider financially preferable. Now, the first step that comes when choosing a project when you're using NPV is that to always ensure that you select a project with a positive NPV. Now in this situation, both projects have a positive NPV. So the next step for us is, in case both projects are, there are, all the projects you're comparing have a positive NPV, the next step for us to do is determine which of the projects have a higher NPV and select the project with a higher NPV. Okay, so in this situation, machine A has 1,580,000 and machine B has 1,04,820. So it's clearly seen that machine B is the project that has a higher NPV. Okay, so as a conclusion, you can write, therefore, the company should select machine B as it has a higher NPV. Okay, as a conclusion, company should select machine B as it has a higher NPV. Okay, so this is the solution to this problem. Let's look at another question. A choice is to be made between 2 competing projects which require an equal investment of rupees 50,000 and are expected to generate net cash flows as under. So we have 2 projects, project 1 and project 2. They've given us cash flows at the end of 6 years. So these are the cash flows. Year 1, 25,000, 10,000. Year 2, 15 and 12,000. Year 3, 10,000 and 18,000. Year 4, 0 and 25,000. Year 5, 12,000 and 8,000. And at the end of year 6, it is 6,000 and 4,000. Additionally, they gave us the cost of capital of the company is 10%. The following are the present value factors at the rate of 10% per annum. Year and present value factors, which they've given us, so we don't have to calculate the present value. And then they've given which project proposal should be chosen and why. evaluate the project proposals under payback period method and under discounted cash flow method. So in this situation, we have to calculate the payback period. We have to calculate the capital budgeting, right? We have to do the capital budgeting based on the payback period method as well as based upon the discounted cash flow method. So we have to use two methods. Now remember payback period method, right? How much time it takes to pay back the original investment. Okay, so I hope you remember the two formulas which we used with regards to payback period method, which is formula number one, which involves, taking the initial investment, dividing it by the actual cash flow. Okay, and then the second formula was the one where we used we gave the base year and then we calculated the there's a certain number of months also involved. Okay, so first steps is in this situation, because we are having uneven amounts of cash flow, so when we're calculating the payback period method, we have to go for cumulative cash flows. Okay, we have to go for the calculation of cumulative cash inflows. So I have already gone ahead and prepared my table with regards to the calculation for payback period method. So you can also prepare your table this way, and goes using payback period method. Under that, I have prepared year, then we have the column for project number 1, and then we have also a column for project number 2. Okay, so under the year column, first to 6 years, okay, first year to 6th year, and then after that under project 1, subdivided into cash inflows and then cumulative cash flow. Similarly under project 2, cash inflows and then cumulative cash inflows. And we've written the values as per the question: 25, 15, 10, 0, 12, 6, and then 10, 12, 18, 25, 8, and 4, project 1 and project 2 respectively for the 6 years. Okay, so this step is done. Next step is to calculate cumulative cash flow. Cumulative cash flow for the first year for project 1, 25,000, and since there are no previous cash flows, it will be only 25,000 cumulative. And in the second year, it will be 25,000, okay, from the first year, plus 15,000 from the second year, so should amount to rupees 40,000. And then for the third year, we already have 40,000, we're earning additionally 10,000, so rupees 50,000. And for the fourth year, we have 50,000 from the third year. In the fourth year, we're not earning anything, so cumulative cash flow is rupees 50,000. And in the fifth year, we have already 50,000 plus earning of 12,000 in the fifth year, so rupees 62,000. And for the last year, 62,000 at present plus 6,000 we're earning in the sixth year, amounting to rupees 68,000. Okay, let's do the same for project number 2 as well. 10,000, there are no further previous earnings, there are no previous earnings, so 10,000 cumulative cash flow. And then for the second year, 10,000 plus 12,000, 22,000. For the third year, 22,000 plus 18,000 should be 40,000. For the fourth year, 40,000 plus 25,000, 65,000. For the fifth year, 65 plus 8,000 should be 73,000. And for the sixth year, 73,000 we are earning in the fifth year, plus new earning of for the sixth year, 4,000, it is rupees 77,000. Okay, so 2 projects. Okay, we've calculated cumulative cash inflows for both the projects. Now let us see how many years it takes to receive the payback. So firstly, check the initial investment that is given. So initial investment is rupees 50,000. Okay, the initial investment amounts to rupees 50,000. Now we have to check when we are going to receive 50,000. Okay, project number 1, first year, 25,000. So not 50,000. So we need to earn some more. In the second year, we're earning 40,000. We need to earn some more. And in the third year, we're earning exactly 50,000. Okay, initial investment is 50,000 and the outflow also is finally 50,000 in the third year. That means project number 3, payback period is going to be third year. Okay, because we're earning the exact amount. Okay, so initial investment is 50,000 and we're earning exactly 50,000 in the third year. Therefore, payback period for for project number 1 is 3 years. Okay, so let's write that in our solution. Payback period for project number 1. Payback period for project 1 is 3 years. Okay, I hope you understand where I'm coming from, where I'm getting rupees 50,000 from. 50,000 is earned in the third year. 50,000 is the original investment. Therefore, payback period is 3 years. Now let's see for the second project. 10,000, 22,000, 40,000, 65,000. 50,000 rupees, which is initial investment, falls between your third and your fourth year, right? It falls between the third and the fourth year, which means the payback period is going to be 3 years plus a few months. Okay, 3 point something years. So let us calculate the payback period for the second project because we don't have the direct answer. So we have to calculate using the formula we've already learned before. So payback period for project 2. Payback period for project 2 is going to be equal to, as we have done before, we took a base year, okay, or the year for the lower amount they were getting. So I prefer to write it as base year plus balance of unrecovered initial investment, balance of unrecovered initial investment divided by cash inflow during the next year. Cash inflow during the next year. And then if you want to express it in months, into 12. This is our formula. Okay, so let's do the calculation. Base year refers to the year in which we are supposed to be earning, okay, or the lower amount year, or the lower cumulative cash inflow year. So as we said earlier, 50,000 falls between third and fourth year. Okay, 50,000 falls between third and fourth year. So my base year is going to be year number 3, which is the lower year among 3 and 4. Okay, so base year is 3 plus balance of unrecovered initial investment. Now in the third year, I have received 40,000. However, initial investment is 50. So balance is, in the third year, we are receiving 40,000, but initial investment is rupees 50,000. So 50 minus 40,000 divided by cash inflow during the next year. Base year is 3, next year is going to be 4, right? And cash inflow during the fourth year is rupees 25,000. So denominator is 25,000 and then into 12. So this will be equal to 3 plus 10,000 divided by 25,000 into 12 is equal to 3 years and some 4.8 months. So 4 months and a few days, 4 months and 8 days, 3 years and 4 months and a few days, and 4 months, or because it's 4.8, so we'll just write it as 3 years and 5 months. This is when you're multiplying it with 12. So if you're not multiplying it with 12, your answer will be 3.4 years. If you're not multiplying with 12, your answer payback period is going to be 3.4 years. Now, if you had to compare, okay, as I've said already, which project proposal should be chosen? When it comes to payback period method, the project with the shorter payback period should be selected. So under this situation, project 1 is 3 years, project 2 is 3.4 years. So needless to say, project number 3 has a shorter payback period, therefore project number 1 should be selected. Okay, so we can write a conclusion. Project 1 will be selected as it has a shorter payback period. Okay, so this is the first part of our solution using payback period method. Next, we have to calculate discounted cash flow method, also known as your payback period method. Okay, so let's calculate using the payback period method. Sorry, not payback period, but your present value method, net present value method. Okay, so when it comes to net present value method, we have to take this part also into consideration, right? The present value factors. So I've already gone ahead and prepared my table using discounted cash flow method, or also known as our present value method. So as usual, we always prepare year, and then cash flows after tax, present value factor at the rate of 10%, present value of cash flows after tax in rupees. And under cash flows after tax, I've given project 1 and project 2. Similarly, for present value of cash flows after tax, we have for project 1 and for project number 2. Okay, so the year, we have 6 years. I've already filled up those that is easily available from the question. And they have given to us the cash flows after tax, which I've recorded here. And then also you have the present value factors, which has been given. We don't have to calculate. So I've filled those up. Now the next step is very simple, right? We just have to calculate present value of cash flows after tax, which is cash flows after tax multiplied with present value factor. Okay, so I'll just give you the values here, and make sure you're just calculating also on the side, just in case I may make some errors. Okay, so present value of cash flow after tax for project 1 is 25,000 multiplied with 0.909. It should amount to rupees 22,725. And for project 2, it is 10,000 into 0.909, so it should be rupees 9,090. And similarly for second year, 15,000 and 0.826, it is going to be rupees 12,390. And for project 2, it is 12,000 multiplied with 0.826, which is going to be equal to rupees 9,912. Okay, similarly for the other years also, we'll just multiply these figures and we will jot them down in your present value of cash flows after tax. So I've gone ahead and filled up the remaining values. For project 1, third year 7,510, fourth year 0, fifth year 7,452, and in the sixth year 3,384. And for project 2, third year 13,518, fourth year 17,075, fifth year it is 4,968, and in the sixth year 2,256. And then now that we have the separate cash flows for each year, we have to calculate the total present value of cash flows. Total present value of cash flows after tax. So for project 1 and project 2, we'll calculate separately what are the totals. So for project 1, it should amount to rupees 53,461, and for project 2, it is rupees 56,819. And in order to calculate net present value, it is present value of cash flows after tax minus initial investment. So from here, less initial investment. Now in this question, there is only a one-time investment of rupees 50,000, which is the original cost for the project. Okay, for both of your projects 1 and 2. So rupees 50,000 in both situations. And deduct this amount, whatever final amount we're getting, 3,461 project 1 and project 2, 6,819. This is our net present value. Okay, this is our net present value amount. And now, again, when they're asking you which project proposal should be chosen, so in this situation, when it comes to the discounted cash flow method, the project with the higher NPV is chosen, which means project number 2 is going to be chosen. So make sure you're writing the conclusion also. Therefore, project number 2 will be chosen. Project number 2 will be chosen as it has a higher NPV. Okay, and so based upon the solutions that we did, if we're using the payback period method, project 1 will be selected. If we're using the net present value or the discounted cash flows method, then project number 2 will be selected. Okay, so depending upon which method you're using, we'll be having 2 different results. Now, if they ask you which is better, I would say project number 2 will be better because it has a higher NPV, because there are a lot of drawbacks with regards to the payback period method. Okay, so I hope you remember when we talked about the advantages and disadvantages. So therefore, it's better to select project number 2 through the net present value method. Okay, so with this, we have completed with the discussion on the net present value method.